Good morning and welcome to Coffee with Mr. V. Okay, we're on to episode 10. We made it, episode 10. Here we are. In order to participate with Coffee with Mr. V, you need to go and grab yourself a coffee or any of your favorite liquid and put it in a mug, a glass, a cup, and then with me, we are going to do the synchronized sip, and that's going to be the best part of your day. So pause me if you need to. Go and run and boil the kettle. Here we go. 1, 2, 3. I love coffee. So today I'm going to move on with the theory of the firm stuff. We've done the revenue curves, the cost curves, we've done efficiency, and now it seems appropriate that we should do perfect competition. So perfect competition has a number of characteristics, and I've put them up on the board already. Okay, the four main characteristics. Different textbooks might say there are different characteristics, but these are the four that I'm comfortable with. And it's also the four that I will use for all other market structures as well. So I always get in the habit of drawing them out in the same way. So then it becomes a routine. Next time I want to do the characteristics for Monopoly, let's say, I'll always do them in the same order. Just to go through them then. F, number of firms. In perfect competition, this is a market structure in which there are a lot of firms. As you can see down here, I'm already beginning to draw a visualization of perfect competition in the real world. So we've got firm A, firm B, firm C, and firm D. That's a lot, okay, 4. We also have something called homogeneity. That means homogeneous goods in this market. So it's microeconomics. We're only dealing with one market, one product. So they are exactly the same. We'll come back to this in a minute, but perfect competition is a hypothetical idea. It's not necessarily there to illustrate real life, but it's still useful, and I'll explain why in a moment. Homogeneity then is the idea that all of these 4 firms here, A to D, all sell exactly the same thing. And I had thought about maybe giving you a kind of visualization with some little Legos with this lady selling some coffee, but actually, I'll just stick with the one that I would normally use in class, which is just to think of something really abstract. Just think of shoes. Okay, shoes are something we all often consider as kind of, being differentiated. There are lady shoes, men's shoes, red shoes, black shoes, big shoes, small shoes, training shoes, etc., etc. In this world, however, there's just the shoe. Okay, there is only one type of shoe. It's grey. It's really boring. Okay, and all of these firms sell exactly the same shoe. There's no such thing as brand loyalty. It's just the shoe. So all of these firms are selling exactly the same shoe, just the shoe. Perfect information then. Again, it's an idea that not only consumers have perfect information about the fact of what all these guys are selling, they're selling the same thing, and also the prices at which they're selling, okay? And I'll put that in at this point, okay? They're all going to be selling the shoe here for £10. Okay, we can fiddle around with this in a minute, all right? But let's say the shoe costs £10. Consumers have a perfect information of that, but also the suppliers have perfect information about how each other is making the shoe. Barriers to entry, there are low barriers to entry. Barriers to entry then are the difficulty or not difficulty with which firms will be able to enter a market. So right here we've got firms A, B, C, and D. What about if firm E wants to sell the shoe? What if they want to get in on the market? Or if we were dealing with coffee again, what if another little coffee shop wants to come in on the act and sell coffee too? How easy is it for them to do it? Well, in this hypothetical state of perfect competition, it's very easy. Barriers to entry are very, very low. In the shoe market, that's probably not true. Okay, so in the shoe market, if you're talking about Nike and Adidas and training shoes, then we've got some very big players in the market. We've got lots of brand loyalty, patents. For example, the new training shoe that Nike's bringing out, which again nobody else can replicate that technology. Probably some high sunk costs in terms of research and development. So that's probably not a good example. Coffee shops, on the other hand, probably are a good example. It wouldn't really cost that much money for us to get started with our own coffee shop, rent a place in Headington, buy a coffee machine there, you set up as a coffee machine. But barriers to entry in perfect competition are minimal. Okay, so there's our characteristics. Well, so what? Well, with the market structures, okay, I would always advise you to start with, well, what does the demand curve look like for this market structure? So I've already made a mistake here. Okay, I'm gonna come back to this diagram in a moment, but I'm going to draw another diagram here and another diagram by the side. Okay, so the market for the shoe. Well, over here in the industry, and the industry here I'm representing as all four of those firms put together, there would be a downward sloping demand curve. As the price goes down for the shoe, more people will be willing and able to buy the shoe, and conversely, as the price goes up, less people will be willing and able to buy the shoe. There is an upward sloping marginal cost curve because of the law of diminishing marginal returns, and that gives us a market price of £10, our market equilibrium price. For each firm then, and this is meant to represent firm A, okay, firm A then takes its price from the industry, okay? If firm A were to increase its price, suddenly selling at £11, then hopefully you can see that nobody would want to shop at firm A. Why not? Because there are homogeneous products, exactly the same products in firm B, C, and D, at a price that's lower to A, and I have full knowledge of that, perfect information. Okay, so firm A would very quickly go out of business. So firm A is not going to do that. Okay, instead, firm A is definitely going to sell for £10. Okay, so firms in perfect competition are what we call price takers. Okay, they have no market power to set their own prices. They must take the market price. What we end up with then is a perfectly elastic demand curve, which basically we have infinite demand. Okay, it doesn't necessarily need to be literally infinite, but a lot of demand at the price of £10. But as soon as we raise the price up from £10, even if it was £10 1p, rationally speaking, consumers wouldn't shop at firm A and they'd go somewhere else. So that perfectly elastic line comes from the derivation of, the intersection of demand and supply in the industry. And now I'll go on to the big diagram. So there is my demand curve, which, as we've noted in previous episodes, is also my AR curve. And since it's my AR curve, we can now draw the MR curve, twice the gradient, but the gradient is 0, so it's also equal to MR. Okay. Then we can draw our marginal cost curve that way. And again, note how I'm always drawing it in the same order: AR, MR, MC. Okay. We do MC equals MR. That gives us our profit maximizing level. If we do this now, it will eliminate future mistakes with the diagram. And we draw up to the demand curve, and that gives us our price. And the price at the moment is £10. Happy with that. Okay, so then I'll draw my average cost curve in, a U-shaped curve or a smiley face curve with the minimum point going through the MC curve. Happy with that. And then just finally, to find profit, we draw up to the AC curve. And that box there then is the supernormal profit. If you're unsure what supernormal profit is, go back a few episodes onto the one I did on profit. Supernormal profit, that would be received by firm A. Okay, so here's the scenario then. Okay, this is happening. All of these firms, I mean, I've told you this is firm A, but equally it could be firm B, C. Okay, they're all making lots and lots of profit. So as we walk down the high street, everybody selling the shoe is driving around in a Bentley. Everybody's buying new houses because they're all really, really rich. They're all making so much profit from selling the shoe. So what do we all go and do? Well, I know what I would do. I'd be thinking, well, I want to get in on that game. I want to make profit too. I want to be driving a Bentley, so I'm going to make the shoe as well. So I'm going to come into the market, and it's easy for me to come in the market because there are low barriers to entry. I'm going to set up as firm E. Right, firm E has come in and is also selling the shoe for £10. Right, now here's an interesting thing. So what's happened now? Well, if you remember back to kind of week 3 economics, anytime that there are more suppliers in the market, you should shift the supply curve to the right, because now at any given price, at the price of £10, there are more shoes available. Okay, instead of having Q1, there's now Q2 shoes available. What does that do? Well, first of all, it creates excess supply. Whenever there's excess supply, there will be a rationing function, where consumers bid down the price because of the excess supply, and that creates an incentive for producers to produce less. That will bring down the price then to a new equilibrium of £9. Remember, these are all price takers, so they will all now reduce their price to £9. If they don't do that, and all the other firms do, then they will lose all of their market share. So what does that do? Well, the demand curve from firm A is derived from the industry. So the demand curve will shift downwards from D1 to D2. What's going to happen in this diagram then? I will do the same thing. I'll just use a slightly different color. The demand curve shifts downwards. Okay, to D2. Okay, let's go through the process then of finding profit again. I need to find MC equals MR. MR, remember, is the demand curve in this case, which is here, Q2. Okay, so firm A is selling less shoes. That's fairly obvious because now there are 5 firms selling the shoe rather than 4. So presumably firm A has a smaller market share than it did before. The price has gone down. We read up, so that's my new price of £9. But it's also my cost because that's where Q2 reads up to the AC curve. So actually now I'm kind of AC equals AR, which means normal profit. Okay, it doesn't mean no accounting profit, but it means normal. It means zero economic profit. So normal profit. And then nothing changes because now there is no incentive for more firms to enter the market or more firms to leave the market. So this is what we call the difference between the long run situation in perfect competition and the short run. In the short run, firms were able to make supernormal profit. In the long run, they were not. That's because profit was an incentive for other firms like Firm E to join the market, squeeze the supernormal profit out of the industry, and all firms are now making normal profit. There is neither incentive to enter or to leave. There's not going to be a firm F in this case. All right, let's have a look at this again, but we'll do it from the opposite angle. Okay, so I'm just going to draw it on this diagram for a moment, and I'll just ignore the industry just because we're tight for time. So here's my firm with the horizontal demand curve, perfectly elastic, which is also the MR curve in this case because twice the gradient is still 0. MC, there's MC equals MR, there's my price, and now here is my average cost curve up here. Ooh, slightly different than before. We read up to the AC curve, that gives us our cost, and now we can see that actually this firm here, firm A, is now making a loss. Okay, so we're walking down the high street, we see that around us that all firms are leaving the market. They won't be able to sustain that forever. Firms might shut down. So now firm E leaves. Equally, it could have been one of the other firms. Okay, I don't know why I keep picking on firm E. Okay, over there in the industry, then you have to imagine that the supply curve is shifting to the left. That's putting upwards pressure on prices due to the rationing function and the incentives function again. That's going to push the prices upwards for all firms here. £10. Well, I don't know. Let's do something slightly different here. Let's make it £11, £11, £11. There. Demand curve will go up to £11. We have our new demand curve. Okay. We go through the process again. MC equals MR is there. Oh, look, all firms are selling more. I then read up to the AC curve. And I see that, well, okay, we'll make it the same thing. All right, costs are there. And now it turns out that this firm is making supernormal profit. Okay, so they've gone from loss-making to making supernormal profit. When there's supernormal profit in the market, that will incentivize other firms to join the market. So now we get firm E again, that pushes down the price. And you can see how this will change, okay? This is still not equilibrium. Equilibrium means that there is no tendency to change. There will only be no tendency to change when all firms are making normal profit. Until that point, if they're all making supernormal profit, other firms want to join. If they're all making losses, firms want to leave. So there's always going to be some flux until that point that firms are making normal profit. So you need to be comfortable with being able to draw firms in perfect competition in the short run, making supernormal profit or making losses. And you need to be comfortable with drawing the diagram that shows them making normal profit in the long run. Okay? MC equals MR. There's my price. Here we go. I'm going to draw my AC curve so that the bottom point here is tangential to the AR curve. That is our long run equilibrium diagram for perfect competition. Okay, we're profit maximizing, but at the profit maximizing point, we're not actually making any economic profit. All right, zero economic profit, normal profit. And that's the perfect competition. So we can recap what we did in the previous lesson based on that. Allocative efficiency. Let's have a look. Our rule for allocative efficiency is does AR equal MC? Does demand equal supply? Demand, supply is here. So it turns out that perfect competition in the long run is allocatively efficient. Yes, for allocative efficiency. Is it productively efficient? So the rule for productive efficiency then is, are we producing at the minimum point of the AC curve? Q1, read up, that is the minimum point of the AC curve. So we can say yes for productive efficiency. Dynamic efficiency. Dynamic efficiency, remember, has two characteristics. You need to be making supernormal profit and you need to have the incentive to conduct R&D. Well, I fail the first characteristic because I don't have any supernormal profit. It's only normal profit in the long run. So definitely not dynamically efficient. Am I X efficient? X efficient is the idea that we would not be spending money on superfluous costs that were unrelated to the production process. I would argue, there's no way of representing this diagrammatically, but I would argue absolutely you're going to be X efficient. If you're not X efficient, that means that your AC curve would be higher than everybody else's. You would be selling for £12 whilst everybody else is selling for £11 because that's how you're because you're passing on the costs of your tropical fish tank onto the consumer. Nobody's going to buy from you, so therefore you wouldn't last very long. So none of these firms are likely to be X inefficient. So we can say tick for X efficiency. Now in the short run, that might be slightly different. Okay, so in the short run, where the margin, the average cost could be up here. Okay, well, that's not allocatively efficient or productively efficient. So in the short run, none of this has to be true. Okay, I could even make supernormal profit and be reinvesting it into the business quite quickly. But the whole point about perfect competition is all these movements are going to happen pretty damn quickly. Okay, firms are going to enter the market quickly because there's no barriers to entry, and they're going to squeeze that supernormal profit out very soon. Now, right at the beginning of this session, I said perfect competition is kind of a hypothetical construct. It is, okay, mainly because of that one. You know, how many goods and services really are homogenous in the real world? Well, I can think of a few. Okay, so the currency markets, the forex market, okay, is a good example. Every dollar is the same as any other dollar. Okay, so when you're buying dollars, they're the same. So it stands, and it stands that all kind of money lenders should have the same rates. And I know that isn't quite true in the real world, but it's a good example of perfect competition nevertheless. Another good example of that would be maybe something like crude oil. Okay, so if you're buying any one barrel of oil is the same as any other barrel of oil. Or another example of that, which escapes me, is the stock market. Yes, so shares in something like Facebook, one share in Facebook is the same as any other share in Facebook. So the stock market is also a very good one. And actually prices are staying the same in the stock market. So every if it's not shoes, but it'd be shares in Facebook, do have exactly the same price in the stock market. Don't let it worry you that there aren't great examples in the real world. Okay, it doesn't matter. What matters is our analysis of this that says it's the most efficient market structure. And therefore it begs the question of even if this doesn't exist in real life, wouldn't it be better if it did exist in real life? And therefore, as kind of free marketeers, if indeed you are a free marketeer, what you would be arguing is that you'd be arguing that you need to get as near to this as possible. You need to kind of lower barriers to entry into markets because you want competition. You want firms to be, because the more competition, the more likely it is that you're going to achieve allocative efficiency and productive efficiency. Okay, you want to increase perfect competition. You don't want asymmetric information. Asymmetric information gets in the way and leads to market failure. You want lots of firms, okay? And the way you get lots of firms is you reduce barriers to entry. So the free marketeer looks at this and says, all right, well, it is hypothetical, but it's almost like a utopia. This is the thing that we need to be aiming for. And therein lies the reason why it is useful for us as students of economics. Fine, very quickly, I just wanted to cover one or two questions that came in from yesterday's session on efficiency. The first one was on productive efficiency and whether it had any, well, actually, it wasn't so much a question, it was just somebody emailing me, and I think they got it slightly wrong. So productive efficiency is all about the short run average cost curve, nothing to do with the long run average cost curve. Okay, long run average cost curves, I think we did in episode 2. The minimum point of the long run average cost curve is called the MES, the minimum efficient scale. Okay, so that's the smallest the firm can be whilst exhausting all of its economies of scale. However, you don't need to be at that point to be productively efficient. Productive efficiency is just, are you at the minimum point of your short run average cost curve? So if you remember, the long run average cost curve is derived from lots of short runs. So for example, if I have a small firm with a short run average cost curve here, I could be productively efficient. Let's say if I'm in perfect competition there, but that wouldn't be anywhere near my MES, but that is still productively efficient. And by the way, whilst I've got that on the board, what I can start to do is now I can map this onto a kind of perfect competition diagram. Sorry, that really should have gone through that point there. Okay, you can see how all these diagrams start to fit together. A very small firm like this is likely to be in a highly competitive market, hence why it would have a perfectly elastic demand curve. It's likely to be productively efficient, but if it were able to grow and go into a kind of more monopolistic type of competition and get economies of scale, it might actually end up with lower costs there, even though it's productively efficient up there. Somebody else was asking me about allocative efficiency and the PPF. Okay, so the PPF, we draw like that. We could put coffee here, and we can put cigarettes here. And the question was, is every point on the PPF allocatively efficient? Well, the answer is no. Okay. Allocative efficiency is the maximization of community surplus. Okay, being on the PPF is the idea that all of your resources are being fully employed. So they're not quite the same concept. And actually, if you think about it this way, if we allocated more resources towards cigarettes and from coffee, you can see that actually we're not achieving allocative efficiency at all down here, because we'd be allocating resources more towards a good that has demerit good, negative externalities, a demerit good. So it's not true that all points on the PPF are allocatively efficient at all. They're two distinct things, and I would try not to get them confused. Okay. So no. All right, that's it. I've gone slightly over than what I wanted to, but never mind. Cheers. Here's to 10 episodes and another 10 episodes coming, hopefully. Okay, bye.